It is Tuesday morning, May 5th, and this is, of course, the video log that takes 30,000 to a million. It's very early in the morning, 6 a.m., and the market's about to open, so the screen is white. It's going to be a little bit brighter than usual. So I don't think I've ever recorded on a white screen. Maybe I have. I think I have like 5 or 6 times. But today, after I show you the account and what's going on, I'm going to talk about VEGA. Okay, one more Greek that we haven't talked about yet. I think it's the fourth one that I'm covering now. And I'll tell you what it's all about. Maybe you can find it useful in your option analysis that you're doing. And I'll show you how it works on Robinhood here. First, going into the markets. This is the account. I'm sitting at 76,823 at the moment. I've been outperforming the markets on the upturn, which is very nice. So if we take a look at a week here, I'm up 2.37%. Let's see if I've beaten the markets. 2.4 versus negative 1.5. So I'm actually positive while the markets are negative on the week, which I'm really excited about. Things are doing well here. I think the main reason why I'm doing so well is because Cameco. But Cameco, I've actually I've pre-sold a lot of that stuff, all of the stocks actually. So I don't have much profit to gain from this. Cameco is already at 11, and most of my options are sold at 10. So I just have a little bit of premium to collect, and that's it. My relationship with Cameco is temporarily over. Okay, that's unfortunate. I wish I didn't sell that many calls, but hindsight is 20/20. So it's not gonna happen. All right, so here are all my options, and looks like the markets are opening slowly here. Markets are up to start the day. Apple is already at 296, and things are going in a positive direction, it seems like. So here are all positions. As always, you can pause the browser at any moment. You can see the number of shares I have and the symbol if you're really interested in more detail. I've really been trying to accumulate some realty income here. I have quite a large position now, 97 shares. It's like $5,000 or so. And nothing really out of the usual here. Energy fuels up a couple $100. Everything's moving pretty steady. I don't know if I need to comment on any of these stocks actually. Alright, so here's the account breakdown. I've been reducing leverage even further. I have a total amount of assets, which is near all-time high because of course I have some margin. I have almost $92,000 worth of assets right now. My margin ratio is only 16.33%, so I've managed to get it down pretty high, pretty low. But most of that is due to account appreciation. So as the pie grows, you know, a $15,000 worth of leverage is not going to seem as much as a percentage in percentage terms as it was, you know, if it's a $30,000 account, right? Then it would be like 50%. Okay, so here's the breakdown. This doesn't really give you much information because there's a lot of selling and buying here. So I don't know if you can get anything out of this total return, but maybe equity. So you can see some of the stock holdings, but not option holdings. So as you know, I've already sold all of the Camecos, basically. I don't get much profit, any profit from that anymore, really. And these are the only two that are positive. I'm sorry, they're not the only two that are positive, but those are the two largest positions here. And then DEM, which is an emerging market dividend fund, and then and then energy fuels, etc. So that's my holdings by size, and here they are by return. The fund that I got hit the most with is New York Mortgage Trust, and that's still recovering. We'll see if it actually recovers all the way. So this is the account breakdown. All right, so now let's talk about the VEGA. I'm not Canadian. So what is VEGA? Okay, VEGA I want to see if I can explain it. Okay, I don't know if you can see it. You can't see the Greeks down here, and I'm not gonna move the browser right now. But so what VEGA is, if I can explain it clearly here, VEGA measures how sensitive an option is to implied volatility movement. Okay, so for example, if implied volatility moves 1%, that's what the VEGA is. Okay, that's how much the price of the option will move by. So for example, if the VEGA is 0.1 and the volatility, the implied volatility of an option goes from 31 to 32%, okay, that means that the price of that option will move by 10 cents. Okay, so if let me maybe, all right, I'll show you an example. Okay, so I'll move the browser. Okay, gotta unlock it here. All right, here it is. Okay, you can see it at the bottom. So the VEGA is 0.01 for this option here. This is all realty income put sell that expires on 5/15 in a week or in a week and a half or so. And you can see the Greeks at the bottom. We talked about delta, gamma, and theta. So the VEGA of this option is 0.01. Okay, so implied volatility is 74.9. That's quite high actually. So if implied volatility moves up a percent, the price of the option will move up 1 cent, but we always times those by 100, right? Because it's 100 shares in each contract. You got to remember that. So that would be basically $1. It'd be a $1 price movement upwards. So selling options with high volatility pays off, right? Obviously, it makes sense that are priced higher. The premiums are priced higher because, the price movement is more unpredictable. It could land really far outside of the strike price. That's what makes the options more valuable, less valuable, right? Because if the volatility is high, it could land really far out of the strike price, and somebody who's, let's say, buying a call option will benefit a lot more from that, right? But they have to factor in the premium. Okay, so it's not a very good deal to buy options with high implied volatility. It's also not a very good deal to sell options with very low implied volatility. Now, if that implied volatility persists, then that's fine, right? It's priced in. But the problem is that implied volatility is not always truthful. So it's up to you to try to predict whether a stock option is overvalued or undervalued based on that. Now, the VEGA itself, it's kind of a derivative measurement of implied volatility. So I personally don't look at it too much, okay? But it can give information to some traders and investors about, and that could help their decision making. Now, some people have tried to tie the VEGA into the bid and ask spread and try to figure out some kind of formulation to help them determine whether an option is priced competitively or not. But personally, I don't see much value in that. So let's go look at the longest term duration stock option that I have, which is this Apple call that expires at 2021. So if we go all the way down here, you see the VEGA is 1.2. So that means that if implied volatility goes from, I think you can see it on the screen, yeah. Implied volatility goes from 32 to 33, then the price of the option will go up $1.23 or $123 for the contract. Okay, so it will go from market value 3,700 to 3,800. Okay, it'll move up $100 if implied volatility changes. That's how VEGA works. Okay, so it's an interesting measurement. to try to help you make a decision here. But like I said, it's a derivative. Now, so the tying in of the prices, right? So some people try to figure out, okay, is the VEGA higher than the bid-ask spread? Okay, and if it's higher, it's supposed to be, a good thing. If it's lower, it's supposed to be a bad thing. So in this case, $1.23 is way higher than the spread, which is 0.5 right now, right? It's 50 cents. So theoretically, this might be one measurement that could help you figure out that this is a good call option to buy. But to me, this is just, the bid-ask spread is a function of liquidity. So I'm not sure where, the value is in that. If you guys are option traders and you use VEGA to try to help you determine and figure out whether you should pull the trigger or not on a specific option, let me know, because I want to know how you how this helps you, right? Because I think of the bid-ask spread more of a function of just liquidity rather than any kind of measurement of whether I really don't know how it's a big deal, how it's a good deal or not a good deal. Okay, so that is let's see if we can fix this here. So that in essence is the VEGA of an option. Okay, just to repeat, it's a measurement of sensitivity, okay, to the implied volatility of an option. And what is implied volatility? Well, it's based on price action, historical price action, short-term and long-term. So, they come up with the equation to try to figure out. You saw that the implied volatility was like 75%, which is very, very high. I don't know if you can see here, but implied volatility you can see at the bottom because I already fixed the browser. Of the Apple option, as we talked about, is 32.44. So it's a lot less. Okay, it's a lot less than the O option. Well, there we go. VEGA. Okay, sensitivity to implied volatility. The number you see is the number that your option will change in price for every % of change in the implied volatility of an option. God, that sounded complicated. All right. Well, that's it for now. Hopefully, you're making more money than me. I'm probably making another video on Thursday or Friday morning. Peace out.